This is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today, I would like to discuss with you about the terminology used in financial accounting and financial analysis. After going through this topic, the learner will be able to understand the meaning and definitions of the terms that are used under financial accounting and analysis. Then, what is meant by accounting? Accounting is the process of recording, classifying, and summarizing financial transactions. It provides a clear picture of the financial health of an organization and its performance, which can serve as a catalyst for resource management and strategic growth. So, it is the recording, classifying, summarizing of business transactions in terms of cash, the preparation of financial report, the analysis and interpretation of these reports for the information and guidance of management. So, accounting information exposes a company's financial performance. It tells whether the company making a profit or just running into losses at the end of the day. So that can be find out with the help of accounting processes. Then explain the purpose of accounting. The purpose of accounting is to accumulate and report on financial information about the performance, financial position, and cash flows of a business. In simple terms, we can find out about the liquidity, solvency, profitability, position of the company. So, this information is then used to reach decisions about how to manage the business or invest in it or lend money to it. The main purpose of accounting is to determine profit or loss during a specified time, to show financial condition of the business on a particular date, and to have control over the firm's property. The five main purposes of accounting are: first one is record transactions. In accounting, only the financial transactions now arranged in a chronological order, which includes the day-to-day transactions of the business, can be recorded, and monitor activity. Second purpose, so as we are going to record financial transactions in the books of accounts like journal and ledger. So in some cases we'll go with single entry bookkeeping system, but when you are going to record the same transaction, whatever we have recorded in the books of journal, that should be entered twice in two different accounts in case of ledger. So that kind of recording the transactions is known as double entry bookkeeping system. Like how whenever they are going to record these transactions, they used to monitor keenly each and every activity related to the business. And next, it will have control over it, management of the business. So one can able to understand the total assets and liabilities and also measure the financial performance. The third one is list out the functions of financial accounting. The most important seven accounting functions are payroll, inventory cost management, reporting financial statement, legal compliance and finance controls, cash collections and record keeping, and accounts payables and receivables. Apart from that, we also have bookkeeping as one of the function, classification of information and preparation of financial accounting and segregating financial transactions. And describe the term balance sheet. A balance sheet is a financial statement that contains details of a company's assets or liabilities at a specific point in time. It is one of the three core financial statements, which includes income statement, cash flow statement being the other two. which are used for evaluating the performance of a business. In simple terms, balance sheet is a statement which shows the assets and liabilities of the firm. It represents the financial position of a firm as revealed by the accounting records. A balance sheet is a financial statement that reports a company's assets and liabilities and shareholders' equity at a specific point of time. The next write about profit and loss account. So profit and loss account shows the net profit or net loss earned by the company, and calculations in the P&L account would be as follows. Add all revenue earned over the accounting period, add all expenses made throughout the accounting period. So why we used to add these kind of things on debit and credit side means whatever transactions we are going to record in profit and loss account, they are nominal in nature. So according to nominal account, one should add income and gains to credit side, expenditures or losses on debit side. The profit and loss account statement is a financial statement that summarizes the revenues, cost, and expenses incurred during a specified period. Then name any four accounting concepts. So accounting concepts form the base of accounting processes. They are crucial as they ensure that financial statements are prepared in a consistent and uniform manner, which makes them more reliable and useful for decision making. So, accounting concepts are the fundamental ideas, assumptions, and conditions that underpin the accounting process. They provide a framework for recording, reporting, and interpreting financial transactions and information. So, accounting concepts are more important because they ensure that financial statements are prepared in a consistent and uniform manner, which makes them more reliable and useful for decision making. So, both businesses and their stakeholders need these concepts to track their financial performance, make informed business decisions, and comply with financial reporting requirements. So, we have different types of concepts, but here we are going to discuss only four like business entity concept, going concern concept, money measurement concept, accounting period concept. Apart from that, realization, profit realization concept, or decision making concept. There are different types of concepts that are available in accounting. The next describe the meaning of ratio analysis. Ratio analysis is a quantitative procedure of obtaining a look into a firm's functional efficiency, liquidity, revenues, profitability by analyzing its financial records and statements. So, ratio analysis is a very important factor that will help in doing an analysis of fundamentals of equity. So, in simple terms, ratio is numerical relationship between two numbers. Ratio analysis refers to the analysis of various pieces of financial information in the financial statements of a business. They are mainly used by external analysts to determine various aspects of business such as its profitability, liquidity, and solvency. So, if you observe this ratio analysis, which is used for comparative analysis, so ratio one companies may comparable with other company. Then second one is to measure trend. So, what kind of trend we are going to take means the ratio at different times. Just taking those ratios, one can able to project the trend of a particular company's financial proposition. The next illustrate about profitability ratio. A profitability ratios are a class of financial metrics that are used to assess a business's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, shareholders' equity over time, using data from a specific point in time. So they are among the most popular metrics used in financial analysis. So profitability ratios can be a window into the financial performance and health of a business. Just by looking at the profitability ratio, one can able to assess the financial status of a company. And ratios are the best used as comparison tools rather than as metrics in isolation. So profitability ratios can be used along with efficiency ratios, which consider how well a company uses its assets internally to generate income as opposed to after cost profits. So profitability ratios throw light on how well the firm is organizing its activities in a profitable manner. The next, elaborate the meaning of current ratio. Current ratio measures a company's ability to pay current or short term liabilities, which are known as debts and payables, with its current or short term assets such as cash, inventory, and receivables. Current ratio is the ratio between current assets and current liabilities. A current ratio of 1.5 to 3 is often considered good. However, when evaluating a company's liquidity, the current ratio alone does not determine whether it is a good investment or not. It's therefore important to consider other financial ratios in our analysis. A company can improve its current ratio by increasing current assets, enhance receivables collection, implementing more efficient account receivable management can speed up cash inflow, and reducing current liabilities, balanced approach to assets and liabilities, and leveraging financial tools and techniques or technology. Then, what do you know about financial ratio? A financial ratio or accounting ratio states the relative magnitude of two selected numerical values from an enterprise financial statements. Financial ratios are calculated on the basis of items of the balance sheet. Therefore, solvency ratios and are also called balance sheet ratios. Then coming to the uses of financial ratios, the financial ratio can be used in two different forms. The first one is analyze firm performance and second one relative performance comparison. So let us start with analyze firm performance. This performance is evaluated with trend analysis, calculating an individual's ratio on a p-term basis and tracing its worth over time. And this analysis is used to find out the source for pending receivables, its average collection time, and decrease in organization liquidity status. Then, relative performance comparison is another type of use of financial ratios. So, here the comparison is between a company's profits with the other competitors. The next, define solvency ratio. A solvency ratio is a comprehensive measure of solvency as it measures a firm's actual cash flow rather than net income by adding back depreciation and other non cash expenses to assess a company's capacity to stay afloat. It measures this cash flow capacity versus all liabilities rather than only short term debt. So, solvency ratios express the financial position of a business. Then, discuss the meaning of journal. A journal is running record of all businesses' financial transactions. It is also known as Book of Original Entry. It is used to reconcile accounts and is transferred to other accounting records such as the general ledger. The journal states the date of transaction, which accounts were affected, and the dollar amounts, usually in double entry bookkeeping method. The journal is the first book in which transactions are recorded in a chronological order, the moment they takes place in the business. Then what is meant by ledger? An accounting ledger is an account or record used to store bookkeeping entries for balance sheet and income statement transactions. Accounting ledger journal entries can include accounts like cash, accounts receivable, investments, inventory, accounts payable, accrued expenses, customer deposits. Whereas ledger is a book that contains several accounts, the process of preparation of accounts from the journal into ledger is called posting the ledger. Examples of common ledger accounts include asset accounts such as cash, prepaid expenses, accounts receivables, and furniture and fixtures. Liabilities accounts including accounts payable, accrued expenses, lines of credit, and notes payable. Then extend the term trial balance. A trial balance is a financial report showing the closing balances of all accounts in the general ledger at a point in time. So, creating a trial balance is the first step in closing the books at the end of an accounting period. So, trial balance is a statement containing debit and credit balances of various accounts taken out from ledger book as on a particular date. Coming to the rules for preparing a trial balance are as follows. All assets must be recorded on the debit side. All the liabilities must be recorded on the credit side. All incomes or gains must be recorded on the credit side. All expenses must be recorded on debit side. Then what is meant by activity ratios? An activity ratio is a type of financial metric that indicates how efficiently a company is leveraging the assets on its balance sheet to generate revenues and cash. So, activity ratios express how active the firm is in terms of selling its stocks, collecting its receivables, and paying its creditors. So, activity ratios are most useful when employed to compare two competing businesses within the same industry to determine how a particular company stacks up among its peers. But activity ratios may also be used to track a company's fiscal progress over multiple recording periods to detect changes over time. These numbers can be mapped to present a forward looking picture of a company's prospective performance. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.